We
Is
said,
America's economic safety
not
net at
only
risk?
is a rate cut
As rate cuts,
not a
layoffs, and
sure
cyber
thing
threats
for the
loom,
December meeting,
Wharton's Jeremy
he's
Siegel warns
emphasized
of
by saying
shocks that could
far
turn
from
Wall
it.
Street's relief rally into a
Those words,
dangerous trap.
I think the Dow dropped
Stay tuned for
150
real
points in
talk about
5
market
seconds after
risks
that.
and whether the Fed is really the investor's last line of
I think
defense.
my take is that this will slow down the bull market. I don't think it's going to stop the bull market. But they are looking at strength in the economy and basically saying, that it's not a sure thing. Now, we have 6 weeks. The next meeting is December 10th. I think the next 6 weeks are very important because even though it ends December 10th is 2 weeks before Christmas, we're going to get a good idea about how the consumer is going to be reacting to a number of tariff increased prices from all the goods that they're going to buy for the holiday season. And we're also going to see whether layoffs from AI accelerate or not. So I think what they're saying is, I want to see that data. And by the way, whether the government opens or not, and I certainly hope by December 10th it's going to be reopened, but I think they're going to have enough data. I think they have enough alternative sources of data to determine whether there is going to be a slowdown of the consumer. The good news is I think the Fed has our back. They're essentially saying if we do see a slowdown, we will cut. But if we see the strength that we are seeing right now, we're going to maybe wait another meeting and see what happens in January.
So you said you think that this slows down the bull market but doesn't stop it. Is that because you think that the market doesn't need rate cuts in order to continue to push higher? There's enough happening on the corporate front, on the economic front? Or do you think that eventually the Fed has to say, okay, we're going to give you what you want?
No, I think that, my feeling is we should be a bit lower. But I also have always said that I don't, we see now the 10-year at 4.10. I never thought people were talking about the 10 years going down to 3.75. Mortgage rates are going to go down. No, I really just thought that lowering that short rate was going to normalize the term structure, which means that, long rates are supposed to be above short rates. Now we have it fine. 410, we're going to get down to 388 on the Fed funds. Now that's narrower than usual. But, I never thought that the really long rate is going to do it. Listen, it's basically earnings. Earnings are great. Guidance has been good. The AI story is still alive. But a lot of investors are going to say, okay, I'm not going to get 3.75%, 3.5% long rate. I've got to recalibrate that, and I think that is putting a lid on it. So I do see an increase, but I think a slower increase as a result of the caution of the Fed.
Mike Santoli was just with us talking about at 6,900, the S&P 500 was already pretty far ahead of where most Wall Street analysts were anticipating, most strategists were anticipating we'd be for the end of the year. How about you?
Yeah, well, it's even above what I am, and I'm pretty bullish on the stock market. Is that 7,000 looked like kind of a slam dunk? It's not a slam dunk anymore. It certainly, I think, can be there, and I don't think that we have a market that is really vulnerable at this particular point to a big decline, unless we really do see, the tariffs sentiment beginning to impact consumer spending. And again, the good news is the Fed does have our backs there. They will lower. If things really fall off the cliff, they will probably even go down 50 basis points. I'm not predicting that, but it's always comforting the market to know that the Fed is looking at it and is not stubborn about whether they're going to lower rates or not.
Okay. Jeremy, if anything, what concerns you?
What concerns me is, again, I'm looking at what the consumer is doing. I like what's happening at trade front. I think that those fears are are certainly being mitigated. I've always been worried cybersecurity. We talk about, maybe doing nuclear testing again on the military front. I always thought that cybersecurity is as important as military security because our world relies so much on us being connected. And I always said the scariest thing is for America to wake up in the morning and not be able to connect to any of their accounts because of some sort of cyber attack. And we have to absolutely make sure that is secure.
That was a little more than I was hoping for.
I'm not predicting it. I'm just saying, we need to spend money on that.
Extreme.
I mean, security today is more than just military security with armored tanks and atomic weapons.
I was talking about concerns for the market. I didn't mean concerns for the entire existential existence. Right. but we'll take it. Unfortunately,
the market, as far as the market's concerned, I think the market concerns are really, are twofold. One, huge layoffs that we see from AI that really send consumer confidence down, or people come away and saying, hey, I bought this for Christmas and it was, $45 and now it's $55. I'm going to slow down my spending. And we see those two reductions. Again,
those are the run-of-the-mill things I was talking about. I hear you.
Those are the two things that I think. But as I say, the good news is that the Fed, I think, has our back there. They say, if I see that, we will absolutely lower rate on the December 10th meeting. So, that's the comforting thing. The worst thing is when you have a stubborn Fed that says, oh, no, I believe, inflation is what I look at. I'm not going to look at real spending.